Two people, same city, same salary, same $25,000 saved up. One of them buys a rental property. The other one buys an index fund. 20 years later, one of them has quietly built more wealth than the other, and it's not the one you think. Here's the number that started this whole video. On paper, one of these two ends up with over $400,000. The other ends up with under $200,000. Most people would call that an easy win. By the end of this video, you'll understand why the loser in that comparison might actually be the smarter decision for most people watching this right now. Stick around, because by the end of this video, you'll know exactly which one, and exactly why almost everyone gets this math wrong. Let's call them Alex and Jordan, both 28. Both make $80,000 a year. Both have $25,000 sitting in a savings account, and both are done waiting. They want that money working. Alex walks into a bank and asks about a mortgage. Jordan opens a brokerage app. Same starting line, same amount of money, same city. From here, their paths split completely, and so does their math. Before we get into the numbers, let's clear out 3 things you've probably heard that are simply wrong. Myth 1. Rent always covers the mortgage, so it's free money. It doesn't, and it isn't. You're about to see the real number. Myth 2. The stock market is basically gambling. 100 years of data says otherwise. It's actually one of the most boring, predictable long-term assets that exists, which is exactly why it works. Myth 3. You need to pick one and stick with it forever. You don't. The smartest version of this decision usually involves both, in a specific order, and we'll get to that order at the end. Keep those 3 in mind, because we're about to prove all 3 of them with actual math, not opinions. Alex takes that $25,000 and puts it down on a $200,000 rental property. That's a 12.5% down payment, and the bank covers the rest, $175,000 in mortgage debt. Here's the part everyone loves. Alex doesn't own $200,000 of real estate with $25,000. Alex controls $200,000 of real estate. That's leverage, and it's the entire reason people fall in love with real estate. The property rents for $1,900 a month. That's $22,800 a year coming in. Feels like free money. But Alex hasn't paid the mortgage yet, hasn't paid property taxes, hasn't paid insurance, hasn't fixed a single water heater. And that's exactly where the story usually gets edited out of most YouTube videos. But not this one. Jordan takes the same $25,000 and puts every dollar into a low-cost S&P 500 index fund. No mortgage, no tenants. No 2 a.m. phone calls about a broken furnace. Historically, the S&P 500 has averaged around 10% a year before inflation. Jordan doesn't do anything else. No renovations, no property manager, no leaky roof. Just $25,000, left alone, compounding. It sounds boring. It's supposed to sound boring. Boring is what compounding looks like from the outside. Spectacular is what it looks like after 20 years. But Jordan has one thing Alex doesn't: no leverage. Every gain Jordan makes comes purely from the market, not from borrowed money working on Jordan's behalf. That trade-off, leverage versus simplicity, is the real fight in this video, not real estate versus stocks. Borrowed growth versus compounded growth. Let's do Alex's real numbers, because $22,800 a year in rent is the number every real estate video stops at, and that's the problem. Property taxes, roughly $2,400 a year. Insurance, about $1,200 a year. Maintenance and repairs, budget at least 1% of the property value annually, $2,000 a year, and that's a conservative year. Vacancy. Even a great rental sits empty roughly 1 month out of every 12. That's another $1,600 gone. Property management, if Alex doesn't want the 2 a.m. phone calls, 8 to 10% of rent. Call it $2,000 a year. And the mortgage itself? On a $175,000 loan at 7% over 30 years, Alex is paying almost $12,000 a year. And in the early years, most of that is interest, not equity. Add it up, and Alex's free $22,800 in rent turns into roughly $2,000 a year in actual cash flow, sometimes less. Some years, it's negative. And that's before the one expense nobody budgets for. The year the water heater, the roof, and a tenant move out all happen within the same 6 months. Every landlord has a version of this story. If you're currently renting out a property, put the actual number in the comments. I guarantee it's higher than you first told yourself it would be. The wealth isn't coming from cash flow. It's coming from two other places, and almost nobody explains this part clearly. Two engines are quietly working in the background of Alex's deal. Engine 1. The tenant is paying down Alex's mortgage. Every single month, a piece of that rent check chips away at the $175,000 loan. After 20 years, most of that loan is gone, paid off by someone else's rent money. That's forced equity, and it's real. Engine 2. Appreciation. If the property appreciates at a historical average of around 3 to 4% a year, that $200,000 property could be worth roughly $400,000 to $430,000 in 20 years. Here's the part that breaks people's brains. Alex only put in $25,000, but the returns are calculated on the full $200,000 asset. That's leverage magnifying appreciation. It's the single biggest reason real estate can outperform on paper, and the single biggest reason it can also go catastrophically wrong if prices fall instead. While Alex is managing tenants, Jordan hasn't sent a single email. $25,000 at a 10% average annual return doesn't grow in a straight line. It grows in a curve. In year 1, it earns about $2,500. Boring. In year 10, that same $25,000 has grown to around $65,000. In year 20, it's crossed $168,000. Same $25,000 Alex started with, nearly 7 times bigger, and Jordan never touched it once. That's the part almost nobody feels until they see the actual chart, because compounding is invisible for the first 10 years and undeniable for the last 10. Most people quit checking their account right before the curve gets steep, and that's the single most expensive mistake in this entire comparison. No property taxes, no insurance, no vacancy, no 2 a.m. phone calls. Jordan pays it forward with time, not maintenance. Let's put both outcomes on the table using the same $25,000, the same 20 years, no extra contributions from either side. Jordan's index fund, roughly $168,000. That's Jordan's full net worth from this decision, clean, liquid, and taxed only when sold. Alex's rental property, worth around $415,000 after 20 years of appreciation. Subtract what's left on the mortgage. By year 20, most loans like this are close to paid off, so let's say $15,000 remains. That leaves Alex with roughly $400,000 in equity. On paper, Alex wins by a wide margin, $400,000 versus $168,000. But equity isn't cash. Alex can't spend a wall. To access that $400,000, Alex either sells the property, triggering realtor fees around 6%, closing costs, and capital gains tax, or refinances and takes on new debt. Realistically, after selling costs and taxes, Alex might walk away with something closer to $340,000 to $360,000. Jordan, meanwhile, can sell 10% of that index fund on a random Tuesday afternoon in about 4 seconds from a phone with no realtor and no inspection. So here's the actual answer. Real estate very likely builds more total wealth over 20 years, mainly because of leverage. But stocks build wealth with almost none of the labor, none of the debt risk, and almost total liquidity. Before we get to the risk, there's one more piece almost every comparison video skips entirely: taxes. Alex gets to deduct mortgage interest, property taxes, and even depreciation. On paper, the IRS lets Alex lose a few $1,000s a year on paper, even while the property is actually gaining value. And when Alex eventually sells, there's a tool called a 1031 exchange that can roll the entire gain into a new property and defer the tax bill completely, sometimes for decades. Jordan doesn't get any of that. Every dollar of growth in that index fund is fully exposed to capital gains, taxed the moment it's sold. No depreciation trick, no exchange, no deferral. That's a real point in real estate's favor. It's also exactly why so many landlords keep buying more property instead of ever selling. The tax code is quietly built to reward staying in the game. Here's why the risk section matters more than the reward section. In 2008, plenty of people were running Alex's exact math. Leverage, appreciation, rent, covering the mortgage. Then, home prices dropped nearly 30% in some markets. The mortgages didn't drop with them. Investors who put down $25,000 on leveraged properties didn't just lose $25,000. Many lost everything and still owed the bank the difference. Jordan's version of that same year, The S&P 500 fell about 37% on paper. Painful. But nobody called Jordan asking for more money. The account recovered within about 4 years, without Jordan doing anything at all. Same crisis. Completely different outcome. Because of leverage, not because stocks are magically safer. Every real estate versus stocks video shows you the winning number. Almost none of them show you the risk that number is hiding. Alex is carrying $175,000 of debt. If the market turns and that property drops 20% in value, Alex isn't just down 20%. Alex is down almost 60% of the original $25,000 investment because the loan doesn't shrink when the house does. That's leverage working in reverse, and it's the reason so many real estate investors got wiped out in past downturns. Jordan's index fund can also drop 20% in a bad year, but Jordan's account simply drops 20%. No margin call, no bank asking for the difference, no tenant who stops paying rent while the market is falling. Higher potential reward on one side, higher structural risk on the other. That's not a plot twist. That's just what leverage always does, in both directions. So which one should you actually pick? If you want the highest probable net worth in 20 years, and you're willing to manage tenants, debt, and the occasional broken water heater, real estate has the statistical edge, purely because of leverage. If you want strong returns with none of the second job, full liquidity, and the ability to sleep through a market crash without a tenant calling you at midnight, the index fund is the smarter version of rich. The wealthiest people I've studied don't actually pick one. They use the index fund to build the $25,000 in the first place. And then they use real estate later, once they can absorb the risk of leverage without it wrecking them. So, if you're starting where Alex and Jordan started, $25,000, one decision. Here's the honest order most people should actually follow. Build the index fund position first, because it needs zero maintenance while you're still learning. Once you have enough cushion that a bad tenant or a bad repair bill wouldn't wreck your month, that's when leverage stops being a gamble and starts being a tool. Real estate rewards people who can absorb a mistake. Stocks forgive people who can't. Same start, different tools. And now you know exactly what each one is actually doing with your money. If this saved you from making the expensive version of this mistake, that's the whole point of this channel. Turning real numbers into decisions you can actually use. Drop a comment and tell me which side of this you'd actually pick, team rental property or team index fund. And if you know someone who's about to make this exact decision with their own $25,000, send them this video before they sign anything. Subscribe to Elite Compounder, because from $0 to Elite, we're doing this one compound at a time.